the question we're putting to you is smaller better? There has been an explosion of new unit trusts and fund managers over the last decade in South Africa. We talked to David O Leary, Director of Fund Research at Morningstar South Africa, to put this question to him first. David, thank you for making the time to join us. But perhaps before we get into the big versus small debate, let's maybe just understand why we've seen such a mushrooming of unit trust growth in South Africa.
Well, I think number one, performance has been in the South African equity markets has been outstanding, and so you've got a growing number of asset managers and money managers and people looking to manage that money. And I think also as the market has developed and you have firms that are able to provide accounting, administrative support, some of these back office functions are able to be outsourced. It makes the sort of the hurdle to get involved with asset management lower, because you can, if you're a money manager, start a small shop and you can outsource a lot of these back office functions so that you can stick to just managing money, and you don't have to develop in-house all those various specialties.
And David, does that leaner outfit then make you a better performer? And that goes straight into the question of whether smaller is better.
I think it's a complicated answer, unfortunately. It'd be nice to be able to just say yes or no to that question. I think there are dangers with firms that become very large that you have to worry about. And there are also dangers with smaller firms. And so you're looking for a trade-off. I personally believe there's a bit of a sweet spot that you'll find where a firm has grown enough that it is a well-oiled machine, it has enough resources, they know what they're doing. They've got experience. They've got a lot of people to help them do it. But they're not so large that they've lost focus, that they have too many assets to manage, and that it becomes a very big bureaucratic machine that then sort of gets lost.
Having said that, then, David, what should one be looking for? Should they be enticed by the idea of a boutique unit trust? What are the key indicators you should be looking for before you get in to make sure that you're really, really aligning yourself with a trust that's likely to perform?
So there's a whole bunch of things that you can look at. I think a couple things that are very important and that you do well to focus on would be, one, look for firms where the managers, the people running the money, also have very big investments in the funds that they run. So what often happens is in the industry is that firms will talk about how much of the company they own, how much the managers and the people who run the firm, how much of the company they own, and they argue then that means their interests are aligned with the investors, which is not exactly true. I mean, their interests are aligned with those of the other shareholders because they want to see, and they have a vested interest in the profitability of the firm. But what you want to see is that the firm and the managers have a vested interest in the performance of the funds and the experience that an investor has investing with that firm. And so it's important that the managers have a significant investment in the funds that they run. Unfortunately, a lot of firms just don't provide this information. They're not particularly keen to give out the private information, financial information of their portfolio managers, but but there are firms that do, and in other parts of the world it is sort of common practice to give this information. So it's a question that investors should ask.
I'm making an assumption now here, David, that as we get smaller and you're working within a boutique unit trust, that there's a likelihood that one could really focus on the portfolio managers. To what extent is experience and a credible track record then even more important than with a larger unit trust? And also in addition to that, does this then rule out newcomers to the field because they wouldn't have that track record and that experience to come in and actually be the driving force behind a unit trust?
Those are excellent questions. So I think that the performance and the track record is very important. The smaller the firm and the fewer people it relies on, you have to then make sure that those people know what they're doing, that they are able to produce excellent results. They have fewer people to sort of share the responsibility. So most of the results come from fewer people. So it is very important that those people know what they're doing, and one way to ensure that is to look at a track record. So it does have implications for who can and can't get involved in money management and expect to succeed. So, you know, a portfolio manager who has no track record managing money in any other arena and wants to start their own money management shop is going to have a very difficult time, and so they should. I mean, you don't have much to go on as an investor if the manager is brand new to the game and never managed any money before. And that doesn't typically happen very often. What happens normally is that experienced managers and executives from larger asset managers leave to start their own smaller shops. And then they would have some sort of track record. Usually the managers have been running other unit trusts at other firms, and you can look to how well they did there and see, you know, whether they're any good or not. It's not always entirely easy to do that, but the information is out there if you look for it.